Hello, everyone. Thank you very much for listening to this video. It's a pleasure for me and for AIG to have Didier and George with us. Didier is a member of the Carmignac Investment Committee, and he's probably one of the people able to give us a very nice input on the market, being considered well, one of the free opinions probably out of the big industry and not being independent manager as Carmignac. So thanks a lot, Didier. It's a pleasure to have you here with us.
Hello, good to be here.
I guess that, well, first question is probably always the same, but how is Carmignac viewing the world? So what is the current situation in your view now about the economy, the pandemic, and lots of things to say?
Yeah, it is a very complex world today. You know, lots of things are taking place at the same time. The pandemic and then the involvement of governments that are trying to influence what's happening, and then the markets that are trying to anticipate all that. The point I would stress, without having to go into the analysis of all these trends, is that we have entered last year a period of sort of a crisis, multimodal crisis in a way, both positive and negative. And what really is striking from the experience of last year is that in these situations, you have really winners and losers. And it's very impressive that not all the ship move together with the tide. Some companies do extremely well, others get really in trouble. Same thing for countries. So I find it actually very interesting and can be profitable in this type of situation. You can really make a difference if you do your homework and you find that some countries, some sectors, some companies will actually do extremely well. 2020 was a good example of that, and I suspect 2021 is going to be like that as well.
Yeah, so you definitely have demonstrated in Carmignac that 2020 was about active management and going out of the indexes, not necessarily company by company, but just being able and having the freedom to go out of them when considered necessary. So there's been a big debate about this, and it's active about passives and so on. You're definitely an active and high conviction manager. Still the case. Why do you think that would be a better environment than what we've seen, not in 20, but in the previous years from now?
Well, the worst thing when you're an investor, and that was the risk, was that basically things don't move anymore. They become totally flat. And when you have a zero interest rate environment, or just about, basically you get no yield, no return, and if nothing moves, then you have no way to regenerate an extra return. So the fixed income space can look tricky right now, and people can be afraid of inflation, of rising rates. But as long as you get movements, then as an active fund manager, there are opportunities to generate value. On the equity world, it's totally different, because in equities you have companies which are able to generate a return, generate growth, if they are positioned on the right markets with the right products and the right offering. So here the job is different. It consists in really identifying which companies are able to generate earnings, whatever the environment. If you get a recession, if you get overheating, some companies, because of their products, their clients, their technological solutions, will be able to generate returns. So in equities, it's really about finding the right companies on which you have strong bottom-up convictions, and then you build a portfolio, managing interest rates risk and investing in long-term equity convictions. And we've been doing that for many years. In 2020, it demonstrated again that when things become shaky, that's the right approach. Sentiment for 2021 is that in the US in particular, there is going to be the convergence of the reopening of the economy with all the vaccination really taking place at a very high speed in the US, plus a lot of involvement of the government, which will support the economy. We believe that at one point, that will have a big impact on bond markets in the US. With long-term rates, possibly going up, inflation expectations going up. Now, that may sound like bad news for bond markets, but when you are an active investor, you can actually use this perspective, to generate returns. There are ways to benefit from rising rates when you're a bond investor. There are ways to benefit from a rise of inflation as well. You have instruments that specifically will appreciate if inflation goes up. So we are positioned that way in quite a meaningful way, mostly in the US because that's where it is happening, but a little bit in Europe as well because the world is global, and you can't really imagine Europe and the US going in opposite directions. So yes, we believe in the fixed income space. What might be bad for indices, for passive investments, might actually for us be a source of opportunities.
Great. So thank you very much, Didier. It's been a pleasure to have you with us. It's always nice to share these kind of opinions and so that active management, high conviction, and properly done work pays in the long run and put us in a far better place because there's always opportunities no matter how difficult and challenging the markets are.
Absolutely.
So thanks a lot. Pleasure to have you with us.
Bye-bye.
Bye-bye.